Today, we're digging into the latest financial results from Vicplas International. And honestly, on the surface, they make almost no sense. It's like the company is telling two completely different stories at the same time. And at the center of it all is a financial puzzle that we are absolutely going to solve together.
So here it is, the big question. How on earth does a company grow its revenue by a healthy 13%, but at the same time see its losses get worse by a staggering 73%? I mean, that just feels wrong, right? More sales should mean more profit, or at least smaller losses. Well, as we're about to find out, that's not always how the story goes.
And just look at these two numbers side by side. That 13.1% revenue growth, that's the kind of thing that makes investors smile. It looks healthy, it looks like progress, but then you see that 73.1% jump in net loss, and it suggests something is seriously wrong. This is the paradox we're here to unravel.
So to figure this out, we've got to look deeper than just these headline numbers. We're going to pop the hood on Vicplas's business, break it down into its core parts, and figure out what's driving the growth, and more importantly, where all the money is going. By the end of this, the strategy behind these wild numbers is going to be crystal clear.
All right, first up, let's get a closer look at the top-level numbers that are creating this whole financial paradox in the first place.
And this table, wow, it just lays it all out there. You see revenue climbing from about $102 million to almost $116 million. That's a solid win. But then your eyes drift down, and you see the loss after tax ballooning from $1.4 million to $2.4 million. So yes, the company is getting bigger, but it's also digging a deeper hole of unprofitability. To understand why, we have to look inside the machine.
Okay, section 2. Let's start with the part of the business that's driving all that growth. We're talking about their medical devices segment, which operates under the name Forefront Medical. Think of this as the company's high-tech, high-growth bet on the future.
And here you go. This chart tells you exactly where that top-line growth is coming from. The medical segment's revenue absolutely soared by over 22%. It jumped from $63 million all the way up to over $77 million. This one division is basically carrying the entire company's revenue growth on its back. It is, without a doubt, the star of the show when it comes to sales.
So, why the big jump? Well, it's a few things happening all at once. For one, the pandemic after effects are fading. Customers who are running down their stock are now placing big orders again. Second, their huge investment, a brand new plant down in Juarez, Mexico, is finally starting to produce. And get this, their in China for China strategy is an absolute blockbuster, with that business growing an incredible 121.5%.
But here's the twist. Even with that spectacular revenue growth, the medical segment is still losing money. Now, there is some good news. The loss is shrinking. It's down from $4.2 million to $2.6 million, which is a big improvement. So things are definitely moving in the right direction. But this part of the business is still a drain on the company's bottom line, which kind of begs the question,
where is all that cash from the extra sales going? It's not just vanishing into thin air. And the answer is actually pretty simple. It's being plowed right back into the business for strategic expansion. This isn't a story about a failing business. It's a story about a business spending a ton of money to get a whole lot bigger.
They're pouring money into three main areas. They've got costs from expanding their plant in China, they're spending more to develop new business and market themselves, but the real cash furnace is that brand new facility in Juarez, Mexico. Building a state-of-the-art medical plant costs a fortune in startup fees, long before it's making you any real money. Vicplas is basically paying the very high price of admission to become a bigger, more global player.
All right, time for section 3. Let's shift gears. We're moving from the high-growth, high-spend story to the other half of the company, the Vicplas Pipes business. This is the old-school, traditional foundation of the entire group.
And wow, the difference is like night and day. The pipes business is solidly in the black, generating $6.7 million in profit. This is the segment that provides a stable financial cushion for the whole company. You could call it the reliable workhorse.
But, and there's always a but, isn't there? It's not a perfect story here either. While it is profitable, that $6.7 million profit is actually down about 13% from what it made last year. So even though it's the part of the company that actually makes money, its performance has weakened a little bit.
So why the dip? Well, the company explains that the market is super competitive, and there are credit risks out there. So they made a deliberate choice to be cautious. They focused on making sure they got paid rather than chasing every single sale. It was a trade-off. Give up a little bit of growth to be more stable in a tough environment.
Okay, so we've got our two big pieces of the puzzle. the fast-growing but money-losing medical business, and the profitable but slightly shrinking pipes business. Let's click them together and see the full picture.
And this right here is the heart of the matter. It's what you could call a strategic imbalance. That $6.7 million profit from the pipes business, well, it just wasn't enough. It had to cover the $2.6 million loss from the medical side, plus all the corporate costs, interest on loans, and taxes. There just wasn't enough profit from the pipes to cover the whole shebang.
And this slide right here lets us follow the money. Sure, raw material costs went up with more production. That's normal. But look at the other items. Employee costs are up to staff the New Mexico plant. Depreciation costs are up because of the new equipment in that Mexico plant. And finance costs are up because of the borrowing needed to, you guessed it, build the Mexico plant. Almost every major cost increase ties directly back to that big bet on future growth.
So, we get it now. We understand the why behind these weird-looking numbers. But the final and maybe most important question is, what's next? Is this big, expensive gamble actually going to pay off? Let's take a look at the outlook. First off, if you want to know where this company is headed, just look at this chart. It says everything. The medical devices segment now makes up 2/3 of the entire company's revenue. The pipes business, while really important for its profit, is now the smaller part of the company. The future of Vicplas is the medical segment, period.
And the company is pretty upfront about this. For the medical side, they're expecting revenue to keep getting better as that Mexico plant gets fully up to speed. But, and this is a big but, they warned that profits will be constrained in the short term. As for the pipes business, demand should be good, but so will the competition. It's a very realistic, cautiously optimistic outlook.
So, when you boil it all down, here's the deal. Vicplas is running a classic corporate playbook. They're accepting short-term pain in the form of big losses and high costs for the promise of a much bigger long-term gain from a global medical device business. The strategy is clear. The investments have been made, and that puzzle we started with, growing sales and growing losses, well, it's solved. The only question that's left is the one that every investor is asking right now. When will that gain finally arrive?